All right, listen up, team. We are getting run around out there. Everyone's balance sheets are all over the place. Your assets and your liabilities are out of position, and money is slipping away unchecked. You gotta get your head in the game and get your accounts in order. What, Jackson? Football? No, this isn't about football. This is about the game of money. And if you want to win this game and hit your goals, then you better know where your money's gaining and where it's losing. What now, Johnson? Are you serious? You don't know what those things are? Well, if you don't know the difference between an asset and a liability, then you better watch this episode of...
Assets are items with some value, like cash, a checking or savings account, coins, and even items like art, collectible cards, or memorabilia. An asset could be something you own, have already paid for, or someone gave you. It's yours to keep, sell, rent, or even give away to someone else.
And the best assets are the ones that keep putting money in your pocket. The money flows in over and over and over again.
On the other hand, liabilities are financial obligations you owe someone or a company, like a loan from your parents or an outstanding balance on a credit card. It could also be a mortgage, auto loan, or student loan. These are financial obligations to others regardless of whether or not you still possess the item you borrowed money for, like a lacrosse stick purchased on a credit card that broke after one game. To keep track of this information, people utilize a balance sheet that lists their assets and liabilities and outlines an individual's financial position at a given time.
Hey, Coach, is this sweet artwork that I bought last week an asset?
Absolutely, but it could also be a liability.
Wait, what?
Well, if you own the artwork, it's your asset. But if you took out a loan to buy it, you owe money to the bank, and that part becomes your liability. As you make loan payments, you reduce your liability to the bank and increase your ownership of the artwork.
Nice!
The difference between what you own and what you owe is called equity. It could also become a greater liability if, due to changes in market demand, or if it gets damaged, the artwork depreciates in value below the loan amount. This means you owe more than what the item is worth, also known as negative equity.
Coach, this is definitely going up in value.
If it does and appreciates, that'll benefit you when calculating your financial net worth.
That's the value of your liabilities subtracted from your assets. You got that, Johnson?
Exactly. If it's a positive number, you're in good shape. That might mean you have money to spend, invest, or save. If it's a negative number, then you owe more than the value of what you have.
That's called being underwater or in the hole, and that's not a great place to be. You get that, Jackson?
Cash flow is an easy way to think of assets and liabilities, where assets put money in your pocket and liabilities take it out. If a collector pays you monthly to display your artwork in their gallery, it's an asset that's putting money in your pocket because of the cash flow. At the same time, if your monthly loan payment is greater than the money coming from the collector, then your artwork is actually taking money out of your pocket, making it a liability. This idea can be visualized as part of a cash flow statement, which also lists your income and expenses. A positive cash flow indicates that you can comfortably afford your expenses and have some money left over for other purposes, such as saving or investing. A negative cash flow indicates that you may need to review your spending habits or access credit to get back on track. Now that you know something about assets and liabilities, it's time to take action. First, consider the things that you currently have. Is it an asset or is it a liability? You might be surprised by what you discover. You might realize that what you thought was a liability is actually an asset, and vice versa. Second, create a balance sheet and a cash flow statement. Even if you don't have a lot of assets and liabilities right now, it's never too early to build good financial habits. Seeing it all in front of you will help you create a plan for all the things you want to do with your money. Third, consider before you purchase. Is it going to be an asset or a liability? Will it affect your long-term plans, financial goals, or immediate cash flow? Being thoughtful about your purchases will make you a smarter money manager. Understanding assets and liabilities is a very important part of managing your financial situation. There are good assets and bad liabilities, but there are also bad assets and good liabilities. It's all about how you'll use them and whether they ultimately put money in your pocket or take it away.
All right, now let's get back out there and balance those sheets. Come on, gentlemen. You too, Johnson. Let's go.
Watch more at PragerUkids.com. And parents, don't forget to subscribe.